storage, we're getting evidence that that is being drained right now. And that suggests that it's becoming less economic to store oil because of a narrowing contango. What is a contango? Well, this is a structure in the futures market where the forward priced contracts are priced at a premium to the nearby. So we continue to see this theme develop and take hold, and take root in the market. That could be another bearish pressure point for prices. Back to you now.
Thanks a lot for that, Sri. Well, it certainly sounds as if the bulls have enough arguments behind them, and so do the bears, actually. Let's bring in Jonathan Kornefeld, Asia Director at Hudson Capital Energy, from our studios in Singapore to see whether he's a bull or a bear. What do you reckon, Jonathan? Which way do prices go from here?
Well, I think, first of all, it's important to look at yesterday's price action relative to what we've seen for the last couple of weeks. You know, the last 6 days especially, we've had 6 consecutive moves higher, from below 62 to above 68. From a technical standpoint, and certainly from a fundamental standpoint, the market was due for a pullback. And I think the surprise EIA inventory data, as well as the dollar action that we saw, was the perfect opportunity for the market to come off. And, you know, 2.5 million barrel build in crude when everyone is expecting a draw was a big surprise. That's what led to the 3.5% drop. And I think, as Sri said, especially this morning, you're seeing a little bit of an uptick. I think you're going to see a good amount of hedge funds coming back in and buying this market on this dip, because there's an enormous amount of paper length funds invested in this market going higher right now, and that is what has driven us higher from the low 50s up to where we are right now. And there is a near-term target of between $70 and $72. 70 is really a psychological level at this point, but between 71.5 and 72 is where a lot of the big profit takers are going to come in and sell out their positions. But in the meantime, I think this is just a bit of a retracement before the market resumes its moves higher.
You know, we did CNBC did an exclusive interview with the Russian President Medvedev, and even though Russia obviously isn't part of OPEC, still as a non-OPEC oil exporter, it's, I would imagine, got some sway in the market. How much influence do you think Medvedev's words would have in the market when he says that he thinks that a fair price for oil is between about 60 and 70 bucks a barrel?
Well, of course, yeah, that has a lot of influence. I think and OPEC especially is trying to backpedal a little bit and trying to talk the market up even higher. Originally, they had said something between 60 and 70, but now that we've gotten up into the high 60s, they're trying to say 75 to 80 is a good price level. I think that's really just a way of getting people more used to these high levels, which really aren't necessary from a fundamental point of view in terms of where we should be right now. The market certainly has a premium of maybe 10, maybe even $15 built into it on the back of the paper buying on the fund side, the speculative side.
In Riyadh, of course, today, this week rather, to talk to the Saudis, and he's really going to stress the case about high oil prices, how that could be detrimental to the recovery process. But another theme is his green energy policy. There's a lot of concern that it could be detrimental for demand in the longer term. Do you think that's a concern that the Saudis share? And how is he going to sell that to them?
Well, yeah, that is a concern that's being put out there, but I don't really buy it all that much. I mean, the first part of what you said in terms of the rising energy prices denting any sort of recovery, you know, gasoline prices on the retail level are still 40% below where they were a year ago, and gasoline demand, while looks relatively better than some other product demand, it's still somewhat anemic. It is over 9 million barrels a day, which is nothing to joke about, but it's still rather anemic with prices 40% lower than they were a year ago. You know, the crude prices rallying, that's really only going to affect the headline inflation number, and with the number of layoffs we're seeing every month now, that's going to keep core inflation numbers low. So I think this is really just a sort of one little spectrum of the investment market right now that is being driven higher right now, and $65, $70 crude is not going to derail any sort of green shoots or global recovery.
And Jonathan, just staying with OPEC, do you find it surprising when the economy is really trying to mend itself that OPEC ministers led by the Saudis are coming out trying to talk up oil prices? The Saudis talking about $75, the OPEC Secretary General, and others talking about between 80 and 90 in 2010.
Sure. Well, I think, especially in the second half of this year, there's going to be a tighter supply-demand situation. We may see more demand coming out of China if their recovery continues. You also have a geopolitical situation between Israel and Iran that could pop up by the end of this year that there's some whispers going around about. So there's still a lot of tension as to what's going to happen in the second half of this year. And if crude can stay in the levels that we're seeing right now, 65, 70, then we may see crude in the low 80s by the end of the year. That's certainly possible. And the low 80s, again, that's not going to derail any sort of economic recovery. It's just not high enough.
Jonathan, it's good to hear your conversation. Thanks very much for your time. Jonathan Cornefeld from Hudson Capital Energy joining us there in Singapore. And coming up on the show, 20 years after the Tiananmen Square crackdown, and China has gone through some major changes, but social instability remains a key concern. We are going to talk about some of the challenges. Do stay with us on CNBC.